Welcome to 501 Crossroads, your show all about nonprofits and the people that make the mission happen. I'm Marjorie Moore, President and CEO of Mind's Eye, and my personal mission is to make nonprofits stronger by identifying and fixing the rubs that so often come up between people and the mission. My fabulous co-host, the nonprofit ninja Natalie Jablonski, is here.
That's right, specializing in helping nonprofits maximize their time, talent, and resources to achieve organizational greatness.
Hey, Natalie.
Hey, Marjorie, what do you know today?
Well, I don't know if you've heard, but there was...
Probably not, because typically I'm the last one to know, unless it happened on Twitter, Instagram, Facebook, any of those types, LinkedIn.
I think you may have seen something on... I would guess all of those except for
good.
Maybe not Instagram.
Because maybe then I caught it in my social media trends. What
probably
happened?
Did. So there's been some changes to the tax law lately.
Wait.
Just a couple. Just maybe
to the tax law?
To the tax law. Like maybe like a 5-inch binder full of changes.
Oh, that little thing. I was worried it was going to be something important, like they were discontinuing wine or something.
No. We don't have to actually worry about
it. It's just the tax law. Might be a little concerning to, like, I don't know, every nonprofit out there. But other than that, it's fine, right?
Yeah, so no big deal. So
I'll be honest. I did see it, and I still really don't understand some of it. Like, I get the basics, but my donors are asking me questions, and... I don't know what to say.
Well, guess what?
What?
I brought somebody who's going to explain it to us.
Yay! Is it somebody we know and love?
It is somebody we know and love.
Oh, I love it. I bet I know who it is.
Jen Vacha from Wallace is back to tell us all about the Tax Cuts and Job Act that was signed in December of 2017. So, Jen, welcome back. Thank you so much for being here.
Thank you for having me.
I'm so glad you're here to explain all this mumbo jumbo.
Right. Well, it's been a big change. Like nothing's changed this significantly for 30 years. So hold on to your seats because here we go, right?
And this is not like the Chicken Little, the sky is falling, just kidding. No, the sky really fell, and we need to understand what that means, right?
The book fell and there's a dent in the ground. So we got to figure out how to get ourselves away from the dent, right?
No, I said 5 inches thick. How actually thick was this law?
In our digital age, I have not seen a printed copy of it. So 5 inches sounds fantastic. I would bank it's probably closer to 10, but who knows? Depends your font size.
All of our environmental nonprofits are applauding you right now for not printing that out. Yep.
We did not print it.
Good. Well, I'm not even sure where to begin with this, Marjorie. Where do you suggest?
Well, so I guess, Jen, let's start with unrelated business income because it seems like something to start with.
Yeah.
So first, give us a quick thing. Okay, what is that? Because I hear about it and like sometimes the board gets worried that we're going to have to pay taxes on something
UBI,
we sell.
Right? They keep saying UBI. That's what that stands for?
Yeah.
Right. Absolutely.
So walk us through that first, what it is, and then what's changing.
Okay. So we already talked about what the code was actually called, the new act. So it's that they abbreviated it the TCJA Act. Okay. So
that's
it's the
what
Tax Cuts Jobs Act. So we'll call it TCJA or we'll call it the Act just so that there's no confusion about what we're talking about.
Good idea.
But really that whole act looked at things that were either no change items, significant change items, or minor change items. So UBI that you're talking about right now is a significant change item for nonprofits. So UBI, Natalie's right, unrelated business income. So unrelated means...
I'm right. Did you catch that?
Yes.
I caught that.
I like that.
Yes.
That's in the notes.
Yeah, Natalie was right.
I mean, we're used to it, but it's nice that you acknowledged it.
It's nice to have the call out when it's correct, right? So unrelated business income. So something that is unrelated to an organization's mission. So what your purpose is as a tax exempt organization. So if it's not related to your mission, it's unrelated. Mm-hmm. It's a trade or business that's regularly carried on. So if it's something that could be comparable to something that a for-profit company does, then you probably are running the risk that it might be UBI. There's some things that exclude items from being UBI, i.e. if you have volunteers carrying out the transactions 100%, or you're selling donated goods, items that are 100% donated, or you're selling something simply for the convenience of your members or the people that you're serving. Those are 3 of your typical exceptions to UBI. But otherwise...
So if you're a nonprofit and you are working on curing a disease, and you happen to also have a thrift shop, and that thrift shop is receiving... The income from that is going to your mission, but is 100% supported by donations. That is not considered taxable. That still follows under UBI.
It would be excluded from UBI because you've got donated goods being sold.
Got it. Because I think that's going to impact a large group of our listeners. So.
Yeah.
Good.
So you don't have to worry about that. But if you do have a UBI stream, so say you've got a mailing list and you decide to sell that to another organization and you're getting income because you sold your mailing list, that's UBI. But say you also have another venture where you've got unrelated income. Maybe this one is from investments. So say your investment portfolio includes a partnership investment, maybe a master limited partnership or something that your broker has gotten you involved with. Well, that would be UBI, because typically those types of investments would be UBI. Under the old law, you could take that income from one of those UBI streams and net it against a loss from the other UBI stream. So if one income had, say $1,000 of income, but the loss item was $2,000, you netted down to $1,000 loss. No tax because you had a loss. Under the new law, that $1,000 income item stands on its own, and you'll pay tax on the $1,000, and the $2,000 loss stands on its own, and you will just carry over a loss on that $2,000 item. So now instead of being able to net them together, you have to look at them separately. You'll still have your exceptions and your exemptions. So $1,000, you'd still come down to nothing, but if it was higher, you would actually have a taxable impact. So one of the biggest things that you're going to see for organizations is if they had smaller amounts of taxable income, they're probably going to have a tax hike because of this. And if they had larger amounts of UBI, they're probably going to have a tax decrease. And the reason for that is because now instead of UBI following your general corporate tax rates, it's a flat 21% for a corporate entity. So if you remember tax rate schedules, if you had a UBI, it was kind of phased in over, the first 50,000 of income and then the next 25. So it was kind of a tiered approach. Well, it took a little bit before you hit something over that 15% limit. Well, now everything is a flat 21%.
Oh, wow.
If you're a corporate entity. Trusts have slightly different tax rates, but most organizations are going to be under that corporate 21%. So two big changes there, the tax rate and then the fact that you can't net those activities together anymore.
Okay. So would that also qualify for nonprofits who invest in like a large building, for example? They use a piece of it, but they rent the other pieces out to other individuals as to offset the cost of that purchase. Would that also potentially apply?
Possibly.
Because I see that trend happening across the country of they get a large donation, perhaps outright or from a planned gift, and the board decides to give them some security with regards to building, and let's do this. And then we'll have this other revenue stream potentially that in the future when the mortgage is paid off that would help with that. And I wondered if that would impact some of those nonprofits that use that investment area. Yeah,
it could. So if in that case, like if it's a building that has debt on it, you might run into what's called the unrelated or the debt financed income streams, which is typically considered UBI. There's a lot of exemptions and exceptions to that being truly taxable unrelated income though. So they would really have to look at the structure of the debt. They would look at the structure of who's using the building, how much of the building is being used for their exempt purpose versus how much is being leased out to other organizations. And if they're leasing out to other nonprofits, there's another caveat in there too. So potentially that could be a UBI stream, but there might be an exception that prevents it from being so.
Okay.
A lot of crazy stuff when you get to start to look at UBI. There's things that you think might be UBI, but then once you get into the regulations, you really are actually okay.
So if we have questions about that, do we ask our accountant? We ask our auditor? Who are we asking?
You're going to want to go to your CPA if you've got one on staff that you're working with, because
they're way too small for that.
If you don't have one in staff, then if you've got a board member or if you have an audit firm, they should be able to help you with that research as well to be able to dig down and understand if you've got an issue.
Okay. Now, one of the other things we talk about a lot on this show is executive compensation, and if you're running a really big organization, what should you be making? I hear there's some changes in how that's going to be taxed.
That is correct. So in the past, nonprofits really were just held to an issue of, do you have a good compensation policy in place? Are you making sure that you're doing your due diligence, you're taking votes and making sure that there's an independent process to approve compensation? So in the past, that was all well and good. You had what we used to call the rebuttable presumption that you had reasonable compensation. That still exists. But now there's a caveat that if you are compensating someone over $1 million, so your larger organizations, if you have comp of over $1 million, anything in excess of $1 million is now taxable, and it's taxed at the entity level. So that nonprofit now just incurred another UBI stream because of the compensation. So it's 21% again for a corporate entity. There's also in with the changes for compensation, there's something called the excess parachute rule. So a golden parachute, if you probably more familiar with that from a for-profit term, but the golden parachutes are, when someone leaves a position and it's a severance, it's not a severance payment, but it's a payment due to their separation of service. So if they meet the definition of a parachute payment, there's an excess amount that gets calculated. And if there is an excess, that's also subject to the taxation now. So 2 big hits on maybe some of your larger nonprofits if they've got, nice sized compensation plans for their employees.
And are we looking at an individual who is receiving a compensation over $1 million, or as a whole, their compensation is $1 million?
Per individual.
Okay.
Per
Because
individual.
I want to make sure we distinguish the difference between the two. Marjorie, I know it goes without saying, but I think you and I just missed that.
We did. It was a 999.
It was so close. That was close there.
Your organizations will thank you. The cash flows are not going to be negatively impacted
there you
now.
go. Excellent.
So the one thing that I was worried about was some things on fringe benefits and employee transportation stuff. Tell us about that, because
that's one thing we try to do. I think a lot in nonprofits, because
pay
some
people for going
nonprofits,
places.
we can't maybe necessarily put it in their paycheck, but we look at other opportunities to be able to reward them and recognize them, and with those other external benefits.
Sure. So
and I would hate to lose the corporate jet. So
well, that's always a nice thing
I was
to
looking at
have.
the corporate shoe account.
So you can still reimburse people for their travel. So that hasn't changed necessarily. But this is more, so the change with fringe benefits from a travel transportation perspective is the transportation. So if you were subsidizing parking or on-site athletic facilities, things of that nature, those are no longer allowed. So it's a limited scope. There's like 3 different code sections. And unfortunately, I could probably get you those code sections, but nobody else wants to hear them.
So if you're in one of those big downtown areas and you're helping your employees pay for parking, maybe it's time to ship that into regular compensation.
Right. That would be something that you would want to just compensate them for because you're not going to get a deduction.
Versus reimbursing. So the same, like if they had a membership to their local gym and they were able to get that reimbursed, it'd be more beneficial for them to just add the extra $20 a month to their normal compensation and say that you have access to this if you'd like to, but you don't have to, type of thing?
Well, so this rule actually only changes on-site athletic facilities. So if it's something totally separate that's under the true other fringe benefit rules, that's probably still untouched.
Okay.
So it's a very narrow subset of fringe benefits that got adjusted here.
Good. Well, I'm glad that any on-site wine consumption is not being touched. By
So that's not being touched.
No, not at all. And my Mary Kay accessibility fund is still available.
So let's talk about education.
Oh, yeah.
Because that could be, I know a lot of nonprofits out there try to help their employees with education. What's changing there?
So if they are an education type facility, there's been no change to those rules.
Okay.
So that's nice for them. The biggest change with education actually comes underneath an individual that's funding their kids' college tuition through a 529 plan.
Okay.
So in regards to 529 plans, those were the plans where you could contribute up to X dollars based off of your state's plan. Missouri is kind of interesting because they allow you up to $16,000 on a joint return and actually take a tax credit for it. In the past, that definition of what was considered a qualifying educational institution was only that college level curriculum. Underneath the new law, so they've expanded that definition of qualified higher education expenses. And in that expansion, they now allow tuition being paid towards a K through 12 education. So your general public, if they wanted to put money into a 529 plan now, they could put the money in and actually utilize the withdrawals to fund private school tuition or tuition for a K through 12 education versus being restricted only for qualified college and university education. So that's that big change.
So this is really good for people who want to send their kids to a parochial school or a charter school or
Absolutely.
something like that.
The only cap is it's $10,000 per child per year.
Okay. So a cheap one of those.
The less expensive. The nice thing is, it's a great tax planning opportunity for individuals because if you know your children are already enrolled in a school, set up a plan, put your funding in there, and then you can just start withdrawing from that for the purpose of doing those tuition payments.
Yes.
Wow.
So now the big one. I know. So, we're worried about what's going to happen
here, folks.
what's going to happen to us as nonprofits, but I think most of us as nonprofits are worried what's going to happen to individuals as this changes, because so many things have changed just to our donors,
Right.
and how their taxes are going to work. So let's start digging into that.
So absolutely. So the big thing that everyone was talking about and everyone was worried about was what's going on with deductions, right?
Yep.
Itemized deductions or standard deductions. So the majority of people that were on the brink of itemizing or not itemizing over the last couple of years are probably no longer going to itemize. And the biggest change on that is because in this new act, the standard deduction has increased quite a bit. So if you're an individual filer, you can now take a standard deduction of $12,000. If you're a married filing joint person or a married filing joint return, it's $24,000. If you're a head of household, it's $18,000. So there's a lot of people that maybe have their home paid off. They are not working any longer, so they don't have any state income taxes being withheld or, a lot of other taxable income sources. So they may not have those main two tax deductions coming into play anymore from an itemizing purpose. So they're going to find a bigger benefit with the standard deduction. If they're under the standard deduction, that means there's no real tax benefit to them for charitable giving. So that's where a lot of the scrutiny is coming into play, because folks are worried, nonprofit organizations are worried that if people no longer feel the enticement from the tax deduction, will they still continue to give? In my opinion, it's going to be yes, because you've got people that have always been in that situation where they've never itemized, or they're in a phase in their life where standard has always been better for them, but they still give something. They're not going to be your gigantic donors. They're the ones that give $100 here, $50 there, maybe $250 for this, or, $500 for that. Not significant in size. Those people are still going to give because they still feel some tie to whatever organizations that they're supporting. On the flip side of that, if you were an individual that was itemizing and you now are capped out at $10,000 for your state or local income taxes, property taxes, real estate taxes, and you still have a home, you're still able to deduct your mortgage interest. The old rules on that were if your mortgage was under $1 million, you were okay. The new law says after December, I think it's December 15th, it's capped out at $750,000. So don't go out and buy a new house, ladies. That's over $750,000 and you'll be all right.
With that fancy salary we just got promoted
right.
to. We were
that
planning on it.
999.
That's right.
Exactly.
So keep the houses.
Keep the houses under.
Too.
Exactly. So if you are, an individual taxpayer and you are now capped out at $10,000 of state tax deduction, in order to still itemize, your interest expense and your charitable giving would have to be over $14,000. So most folks, even with a moderate sized, mortgage on their home, are probably in the neighborhood of anywhere from $8,000 to $12,000, $14,000, $16,000 maybe a year on interest expense. They're still going to itemize, and they're still going to get a benefit then from their charitable donations. Okay. And the big kicker right now is they have eliminated the itemized deduction limitations. So that's another benefit.
Tell me more about that.
So if your income was too high in the past, your AGI ended up too high, your itemized deductions would get limited. And so you wouldn't necessarily get everything that was on that Schedule A itemized deduction worksheet. You might have had, it was called the 3% Ps adjustment. That's gone for 2018. So now if you see $10,000 on state taxes and you see $12,000 on your mortgage interest line and you see $8,000 on charity, whatever those add up to, that $30,000 is truly going to go now on your return as an itemized deduction of $30,000 with no P's limitations being applied anymore. Wow. So that's a good thing.
Yeah.
So there's still a lot of there's folks out there talking, maybe 80 to 90% of people aren't going to itemize anymore. I don't feel comfortable with that number. Not that I have a better number in mind. I just don't think there's as many people that are going to be as negatively impacted by that as maybe we think or are hearing.
Well, and I think what we're forgetting through all of this as well is that people give with their heart.
Absolutely.
And they remember their pocketbook, right? Or their checkbook or their taxes, but they give with their heart. And if you have done a great job as an organization building that rapport and that relationship and that connection with your donor database, then this will definitely be something that they think about, but it's not something that is going to lead their decision, in my opinion. Yeah. It may have some challenges for some of those larger gifts, where before it was like, oh, well, I know it's a taxable, I know it's a tax deduction. it may slow that process down. They have more conversations with their personal CPAs before they move forward. It may change when those gifts come in, because they might be looking at, well, when is the right time to make that gift? But I still think that we're going to see the support of the community.
Absolutely.
I don't know what the number looks like you. I don't
Right.
have the data, but just based on my experience, that's what I look at.
Right.
And I know a lot of states provide tax credits for certain gifts and things like that. This doesn't change any of that, correct?
Not
Or maybe
necessarily.
kind
This
of
doesn't
maybe?
directly change any of those, but some of the states are talking about, cutting certain programming or cutting certain credits. And I know even like the state of Missouri has made some adjustments to some of their credit programs. So those would be on a state by state basis.
Okay.
And that will depend. So it's not going to be impacted directly here.
Okay.
But one of the other good things to think about, which Natalie just alluded to, is now changing those conversations with your donors, right?
Mm-hmm.
So no longer, in the past it used to be, oh, well, this would be a great tax deduction for you and you could write it off. Let's get this done now before the end of the year. Now you're really going to spin those conversations and truly drive those benefits of, we're doing something that you're passionate about. You're seeing the impact that we're having on the community. You know that we've had this much of a great turnaround in this particular problem that we're serving. And doesn't that make you feel good? And so you're really going to spin those conversations of giving back to the whole reason that they give, rather than the tax deduction that they might or might not get. Right.
Yeah.
So it's just a change in those communications. And again, it's getting also to the personal side of why people give. You want to know your donors, and you're going to talk to that donor differently than you talk to another donor.
And I know that the individual tax rates have changed, so maybe people feel like they have more money with our new paychecks.
They
Maybe.
might. They might. And, if you're somebody that's still going to be able to benefit from itemizing your deductions and you give nicely with charity, another perk is, if you're giving cash to a 50% charity, which would be considered a public charity, now you can deduct up to 60% of your AGI instead of just 50%.
And AGI is adjusted gross income,
It
right?
is.
To make sure everybody knows what our AGI is.
Yes. Natalie's got another abbreviation
right
down
again.
pat.
Ding! There's a gold star. I just saw it.
Absolutely.
Let the show notes reflect.
Can we talk about appreciated assets for a moment? Because one of the things these conversations have sparked with my circles has been appreciated assets and the ability for people, especially if you have an IRA, for example, you're 70 and a half years old, you have to take that automatic income, right? That's going to come in now.
Required minimum distribution.
Right. And how you could actually redirect that, as opposed to having to take that and then get taxed on it. You could redirect that payment directly to the charity of your choice and then forego having to have that taxable income, right?
That is correct.
And so for those who don't understand stuff like that very well, what is an IRA? What does that look like?
Sure. So your IRA is your individual retirement account. So we're all full of acronyms today, aren't we? So your individual retirement account.
Yeah.
So depending on how you funded that IRA, it could have been that as an employee, you funded a 401k while you were working. And then when you left service with that company, you rolled it to an IRA. Or it could be that you were self-employed over your entire career and you started your own self-employed individual retirement account and you funded that. Either way, IRAs, once you hit 70 and a half years old, you're required to start taking distributions from that account. If you're an individual that decides they really don't need that money from the account that they're required to take out, you can elect, as Natalie said, to have that RMD, that required minimum distribution, directly directed to a nonprofit organization. So it doesn't hit your income. You don't claim a deduction, but you didn't have the income recognized either. So it's a nice way to transfer that required distribution to a charitable beneficiary that can actually utilize it for greater good.
And can it only be redirected to a charity, or can it be redirected to, for example, if I wanted to give it to a child or an aunt or a spouse or something?
No, it can only go to another charitable organization. Correct.
So this is a huge opportunity for
Absolutely.
people who perhaps are not looking at what they could be doing with this, and they're dreading having to take that income now and add that to their bottom line.
Right. And it's going to be a great estate planning tool for a lot of folks. So now, one of the other things that did change is our estate tax limitations.
Right.
So in the past, it was really, really low. And then most recently it went to 5 million and now it's at 10 million. So the idea of getting money out of someone's estate may not be as pertinent anymore. But the idea that you have this IRA and you know you really don't need it adding to the estate, it might be a nice option to be able to designate those charitable beneficiaries to take those RMDs as you're going.
And
I'm not going to claim to be an expert on estate planning by any means. That is not my forte.
So someone who says, wow, this is interesting, I'm going to be hitting that this year, or this is something that I know I'm going to have other people that are be involved. Is that something they should be talking to their financial planner or their CPA or their neighbor's dog? Who should they be talking to about this?
I don't know. Unless the dog is really well versed, I don't know if they'd be very helpful.
That's true.
For certain, they want to talk to their CPA or their tax advisor to make sure, that they have everything under control. And then primarily it's going to be their broker, their investment advisor that handles the paperwork to make sure those designations go where they're supposed to.
And I would suggest, even as bold as to suggest, that you talk to them early, sooner rather than later, because if they don't understand your intentions, because it's something they know you have to have, it may be a conversation that you had years ago that, well, when that happens, just automatically we'll do it and we'll do it on this day. And you may not remember that conversation as clearly. So you'll want to get in there before that distribution happens. You can't put the genie back in the bottle once the genies come back out, right?
That's very true. Yeah. Very true. So 70 and a half, it's the magic number time period in that
I've got
year.
a couple years. What about you, Margaret?
I can't even. So there's a couple other changes, like in the corporate tax rate and a couple other things. How's that going to affect us?
Yeah. So the corporate tax rate, we kind of talked about that a little bit with UBI. So corporate rates are now a flat 21%. So that's where that comes into play for nonprofits because of the whole UBI issue. Okay. Trust rates are the same. They had some alternative schedules get put together. So I think they've got 4 rates now instead of, the old rates that they used to have. So they're not going to be taxed as heavily if they were higher corporate income levels. But UBI is still just a big deal for nonprofits.
Excellent. Anything else we need to know about all this?
The biggest thing that's going to be out there is just communication, making sure that, like we were talking about, having those conversations with your donors, really making sure that you're on a personal level with them. Maybe that's a way that you're redirecting how you talk to those donor bases. You want to continue cultivating those relationships so that you have that giving from the heart rather than giving from the back of their mind where they're thinking about their 1040 and how that's going to impact their tax schedules.
Yeah. And I know that there were even some questions out there about some changes for private universities and tax exempt bonds. Where should we go for information about that if that affects our organization?
Sure. So that would be one of those minor impact idea areas that we were talking about. So if you're a private university that has X dollars of investments and X number of students, a new excise tax applies for those organizations. There's, some other things out there that are specific to tax exempt bonds, what's considered deductible interest now and what's not. So again, you're going to want to just talk to your tax advisors if you are in one of those circumstances where you're either a private university or you have tax exempt bond financing.
And even better,
what's that?
I know that Jen and several of her colleagues are going to be putting on a training very soon here in the St. Louis region. Jen, tell us about that, how we can get registered, go see this.
It costs $1 million to attend.
It doesn't.
Oh, good.
It's even better than that.
And there's no UBI tax on it either, so it's bonus. And if you're a CPA, you get 1 free credit hour of CPE.
Wow.
So it's perfect.
It is a win-win-win.
It is.
So now when's that going to be?
So we are hosting 2. This is our nonprofit speaker series that we try to do 3 times per year. The first session is going to be February 21st in our Creve Coeur location, which is actually at the Jewish Community Center in St. Louis. And then our second follow-on session will be the week after on February 28th, and it will be in our St. Charles site, which is the Spencer Road Library branch.
Okay. And those are both in Missouri. So for
both
our listeners across the country, we love you and appreciate you. And I wish you could get here, but come on in and visit us and then look us up in 501 Crossroads and we'll catch up with you, right?
Have some coffee or wine.
Or wine.
Hey, before we go, just because 'tis the season of taxes, right? I've had some questions about, hey, we have to get tax receipts out to all of our donors. And what's the basic minimum we have to make sure we do? Can we have a quick chat about that?
Sure, absolutely.
I think it'd be valuable for some of our nonprofits. So the minimum requirement that we need to do in order to meet requirements for our donors, because I'm sure they're all balking right now. It's getting close to the end of the month, right?
It is. Yeah. So a donor has to have a letter if it's a donation of $250 or more.
Does that include in kind?
It does include in kind. Okay. Well, Let me caveat that.
Kind of maybe.
They have to have a letter for their in-kind, but your letter should never include a dollar amount if they gave in-kind.
Say it again, Jen.
If you get in-kind donations, you should never put a dollar amount on that letter.
Ever.
What if it's a car that you sell?
Then you have different reporting.
That's
You've got a
totally
1098C that you should be
Totally
issuing. So
different,
there's
yeah.
total differences there. Yeah.
But for my auction items that I'm collecting.
Thank you
No
for
value.
your basket
No
of
value.
wine, which was delicious and absorbed before the event. I mean, what?
No.
Oh, wait a minute. Well, now let's talk about that. No.
Yeah, obviously, there's exceptions to the rule. I've had people ask me a lot about artwork or things that were valued over $5,000 because there's tax forms. That's not what we're talking about. We're talking about your everyday. I've donated something to the auction.
Right.
I've donated something, some office supplies. And oh, by the way, I paid $70 for these office supplies. I'm always like, thank you. Keep that receipt
Yes.
and staple your receipt that you have to our thank you letter, because that is going to be your proof if you ever get audited as to how you claim that value.
That is absolutely 100% correct.
Oh, 3 times in a show.
Triple
My
gold
goodness.
stars.
Telling you. Now, the other question I get often on this is, well, throughout the year, Natalie, we send a letter. So if I get a $150 donation from Marjorie, we send her a letter that says, thank you for your donation of $150. No goods or services were received. Please retain this for your tax letter.
Perfect.
Do I then now in January have to collect all those donations and send her a receipt for the year? Or is that something that would just be a matter of convenience that you would want to do if you wanted to do that, but it's not required?
Correct.
Okay.
So as long as you've acknowledged the gifts during the year, there's no obligation for you to send a summary letter at the end of the year, as long as you've met those other requirements. So
And is there a due date we have to have all this done by?
most folks recommend following that January 31st timeline just because it falls in line with W-2 reporting and 1099 reporting. So it's a convenience. Regardless, a donor is supposed to have that letter before they file their tax return.
Okay.
So it has to be, the main phrase is that it has to be contemporaneously documented. So it's hard to be contemporaneously documenting if you don't give them to them until November of the following year. A, it's not contemporaneous, and B, they probably already filed the tax return, otherwise it's late.
Cool.
So
Yeah.
double
That
issues
brings
there.
up one question, because we have a couple donors that give so many gifts that they're like, please don't give me 100 thank you letters throughout the year. Give me one. So that one that I'm recognizing from January 2nd of the year before, and I'm getting that letter and it's in that pile and that we're sending out the next end of January. Is that cool? I mean, it's
That
in
is
the
cool.
database. and-
Yeah, that is
Okay.
perfectly fine because it's for the tax year.
The
So you're
tax
sending it within a contemporaneous period after the end of their tax year.
Cool.
So it's perfect. And they'd probably rather have that.
Perfect. Look at
and,
that.
And actually, you know what? Their CPA would rather have one letter
man.
versus 20 letters to try to reconcile to that summary letter too.
When you've got that donor that has his donation coming out of his checking account once a month,
Which is
you know,
great.
12
We
of
love
them.
those.
Yeah. So
And the big
keep
key
that guy
too on
happy.
that is no goods or services were received, or
Absolutely.
goods and services were received in the approximate value of.
Correct. And that's your
Because
fair market value.
That's got to be in there somewhere
Yes.
because it's got to be defined, right? And
Correct.
that's especially important, not when someone writes you a check outright, because odds are there's probably not goods and services received, but if they're attending your event and they drank their wine and they had their dinner and they participated in the event, there were things that are taxable that have to be taken out of that prior to. I've had a client before who was doing a golf event and they charged a certain amount. And when they finally did the receipts the right way, we got them back on track. They realized they were giving away more than they were bringing in.
Oh, no.
But they were making it through sponsorships, which is how they kept making all these, the actual profit of the event.
Right.
But the letter now said basically none of your donation was, it did not go over well, obviously, with their group, and they had to really reevaluate the whole event. And
Sure.
their committee was just crushed, but they were giving away a lot of freebies, and
Right.
it was a fun event. Don't get me wrong. But that's really important, I think. And if you have questions about tax letters or how to put those together, again, going to a great CPA can put you right on track and
Absolutely.
make sure it keeps you out of, as I said, the orange jumpsuit, right?
Right. Yes. We don't want to be on the wrong side of the IRS or the state agencies. So
Exactly.
So if they're writing feverishly, as I suspect they are, all of our fabulous audience, and saying, I really need to find a resource, someone who knows what they're talking about. And that Jen, she sounds classy and sassy. How do they get a hold of you?
Well, they are welcome to find me on our website, which would be bswllc.com, or they can reach out to me on LinkedIn through Jen, Jen, Vacha, V as in Victor, ACHA, or via email at jvacha@bswllc.com.
Great. And we'll make sure that Marjorie gets all that in the show notes for those of you who are rewinding your podcast quickly to catch all that. But we love having you in the show. You are fancy and sassy and all that's great. But really, you make it less intimidating. When you hear taxes, it's like the movie in Lion King. It's like Mufasa. Oh, like you just shudder taxes.
I don't want to talk about that.
No, I don't want to talk about it. But we have to. And we have to not only for ourselves, but for our donors. And you make the conversation so easy. Thank you so much.
You're welcome. Thanks for having me.
And thank you to all of you for joining us on 501 Crossroads. 501 Crossroads is recorded at the studios of Mind's Eye Radio and is produced and hosted by me, Marjorie Moore.
And me, Natalie Jablonski.
Mike Curtis is our sound engineer. Please go to iTunes or Stitcher or your favorite app and subscribe and leave us some feedback so others can find us. You can find us on Facebook at 501 Crossroads. Thank you for listening, and remember, we're all working towards the same outcomes.